Hello again, everyone. It's 8 o'clock a.m. Chicago time on Tuesday, June 6, 2023. I'm John Kosar from Asbury Research, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe are the most important to be aware of and potentially the most influential to U.S. stock market direction over the next several weeks to several months, possibly stretching into the latter part of this year. In our previous Your Daily 5 on May the 8th, we said, number 1, that the S&P 500 was in a sideways investor indecision pattern that started in December. Number 2, that our Asbury 6 risk management model was neutral to confirm that investor indecision. And number 3, that our CARP model, which is our cross-asset model that we're going to look at in just a few minutes here, was leaning positive towards a bullish resolution to the indecision pattern, I should say, in the S&P 500. Last month's positive bias in the CARP model turned out to be the precursor to the S&P 500's bullish breakout above 4,200 over the past week. So let's take it up to the present now and let's follow the money. Number 1, the S&P 500 is breaking out from 6 months of investor indecision. So here we have the S&P 500 daily going back to July of last year, and we have this indecision period kind of cordoned off here in red. It's bordered by 4,200 on the upside and 3,800 on the downside. So 3,800 was basically the lows that we made at the end of last year in the middle of March. 4,200 is the peak in February. Another peak at the beginning of May, another peak at the latter part of May, and finally here's the breakout that we've had over the past few days. The breakout was the eventual result of the Asbury 6's move back to a positive bias on May the 18th. Right around here is when our Asbury 6 went back to positive. We're going to look at that a little more closely in just a moment. This breakout suggests the potential for an additional 7% to 12% rise to the 4,600 to 4,800 area. This is based on some longer term charts that I don't have time to show you here. We have them displayed in the research center at asburyresearch.com. But those patterns are the result of the breakout that we've had here above 4,200. Near term, which is kind of what we're tracking here with your Daily 5, is 43.25 is our next obstacle for the S&P 500. It's the benchmark high that we made in August of last year. If we get through 40.25, I think that is going to open the door for more strength. The next level is 46.37, by the way. Through 43.25 sets the stage for a move to 46.37. And now we're starting to hit those targets that I talked about. Market internals. The Asbury 6 is positive. So here we have the Asbury 6 up here through yesterday, June 5th. And for those that aren't familiar with the Asbury 6 through either your Daily 5 or Asbury Research, the Asbury 6 is a daily indicator that I built 5-6 years ago to help me determine what the real underlying daily condition of the market is, much like a doctor does when you walk in for your annual visit and he takes your pulse and he takes your blood pressure and he checks your reflexes. That short little battery of tests just to see what your baseline health is. That's what the Asbury 6 is meant to be for the market. It was getting more and more difficult to determine this by looking at the S&P 500 and maybe volume, because the S&P 500 could be up 60 today and down 60 tomorrow. And it's very easy to get sucked into those moves. I know we've all done it. We're bullish on the market. The market has a couple of bad days where it's down 50 and then down 40, so we get out of our long. Next day, the algos come in, drive that market up 70 or 80 points. So now we're sitting on a loss on our first entry, and we're forced to buy the market back at some point so we can get back to the original idea. The Asbury 6 is very good at helping us not do that. So as I said, the Asbury 6 went back to positive on May the 18th, right down here. Prior to that, you saw a lot of up, down in the Asbury 6. We call it blinking. Blinking is when the market is kind of generating energy in a very small space and getting ready for a breakout or a breakdown. You can see one more clearly here back in August of last year. So we set the August high last year, I think August the 18th, and then we had some blinking here, and then when we finally broke down, that told us on August 26th that this was a valid top. And this gave us a big move down to the October 18th low. So right now the Asbury 6 is positive. The 6 metrics in the Asbury 6, only one of them has to do directly with the S&P 500. That's the rate of change in the S&P 500. The other 5, on purpose, do not directly come from the S&P 500. We're trying to avoid the noise that we get day to day in the S&P 500. So we're looking at stuff like relative performance of stocks versus high yield bond prices, investor asset flows in the spider, high yield corporate bond spreads, trading volume, market breadth. As long as these stay positive, it's going to tell us the patient, so to speak, is healthy enough to keep moving higher, maybe break through that next resistance level that we identified in the S&P 500. Number 3, sector rotation. The SEAF model favors offensive XLK, XLC, and XLY. The SEAF model, SEAF stands for sector ETF asset flows. I built the SEAF model because sector rotation sped up 5 to 10 years prior. About 5 to 10 years ago, I think, is probably a good guesstimate for that. Prior to that, sector rotations would last a quarter or two. You can see them on the chart. Plenty of time to get in, plenty of time to get out. It's much faster now. Your entries and exits have to be a lot sharper. You need a more agile model. So we built SEAF, and SEAF, rather than measuring the relative performance between these 11 sectors in the S&P 500, it's measuring the asset flow that's moving around those 11 sector spiders. And the ones that are moving assets in the fastest are getting the best score. So you can see last week, technology, fastest assets in on a trading basis, which is 1 week, on a tactical basis, which is 1 month, and on a strategic basis, which is 1 quarter, or 63 business days. Got a great ranking here of 3. Second was XLC, or Communication Services. We've got a ranking of 3. In trading, 2. In tactical and strategic, 2, for a score of 7. Any score 15 or less is favored. It's like golf. The lower the score, the better it is. Down at the bottom here, we see a lot of red. These are where the money has been coming from. You can see the 3 with the worst scores are industrials, financials, and energy. So let's look at financials here right in the middle. It was 8 out of 11 in terms of assets in. In other words, there was assets moving out of there and moving into these better scoring sectors. You can see it was second worst on a tactical basis and second worst on a strategic basis. So while the market's been grinding sideways and making us all rip our hair out over the past 6 months, our SEAF model has been overweight technology and communication services for most of the year. Technology has been favored by SEAF for 14 of the past 17 weeks, beginning on February 6th, and has outperformed the S&P 500 by 13% since then. SEAF has also been overweight communication services for 9 of the past 10 weeks, beginning March 27th, and has outperformed the S&P 500 by 4% since then. So year to date, these 2 have been the best performing sectors. Why? Because that's where the money is going, and we can identify that money flow on a week-to-week basis using the SEAF model. The one that I'm watching very closely now for a new opportunity is number 3 here, consumer discretionary, or XLY. Ranked number 2 in trading, number 3 in tactical, and number 3 in strategic, right on the heels of the 2 leaders. This could be a buying opportunity for us as we start to move into the month of June. Domestic asset allocation. The CARP model favors growth in tech since January. Again, when the market's moving sideways and there's not much to do because the ranges are choppy and they're very tight, sometimes the game changes to relative performance. That's been the case this year. CARP stands for Cross Asset Relative Performance, and thus far in 2023, our CARP model has favored growth and technology as overweight. You can see growth over value here. since January 26th on a strategic quarterly basis. And then you can see technology here over the S&P 500 since January 20th on a strategic basis. Growth has outperformed value by 20% since Jan 26th and has outperformed the S&P 500 by 11% since then. Technology has outperformed SPY by 16% since first appearing as buy overweight in CARP on the strategic on January the 20th. Both of these CARP model signals remain intact heading into this week. So even though they've both had very good runs, they're still showing up in the charts as opportunities. Another one I wanted to leave you with here, small cap has really been downtrodden for many months. Look at small cap here. Small cap starting to outperform large cap on a trading basis, which is weekly, and also on a tactical basis, which is monthly. I'd like to see this trend extend all the way out to strategic. It's not there yet, but this could be the early sign of a longer-term opportunity to buy small cap when it's very cheap. Number 5, the bigger picture, SPX's quarterly rate of change. So what we're looking at here is a weekly chart of the S&P 500 going back to the middle of 2018 on top. Down on the bottom is the 13-week rate of change in the S&P 500 or SPX. These red highlights show periods that the 13-week rate of change was negative. You can see that was from October 2018 to February 2019. It's a pretty good trend down there that we would have avoided simply if we just looked at the 13-week rate of change was against us. Here's February to May of 22, which of course was COVID. Here's the COVID low right here. Now this last one is January to November of 2022. That was the major downtrend of last year. Since December, it's cautiously, the 13-week rate of change has cautiously been moving back up above the zero line. But it stayed there. It tested it on March 10th and April 28th, stayed there. Now it's testing the peak that this indicator made on January the 13th. I'm showing you this because this suggests to me the potential for a much larger move higher after we've had a downtrend that lasted for a whole year. So this suggests to me that a new strategic broad market advance is underway, and it kind of corroborates what we're seeing in the S&P 500 as it rises above 4,200. Let me leave you with one more interesting piece of information. Since 1957, the S&P 500 has ended the year in the red just 18 of 65 times, including 2022. On 14 of those occasions, the index returned to the green the next year, a positive year the next year, and on average, the S&P 500 gained 15% in the years following a negative year. So again, not something I would ever trade upon, but I think within the context of what we're talking about, it adds a little bit more excitement for me as to what this year could become. So there it is. There are my 5 most important and influential market metrics to watch according to Asbury Research's data-driven approach to stock market investing. As the data changes and the money moves, we will continue to provide the latest data-driven market intelligence with a focus on following the money rather than trying to make a lot of long-term forecasts, forgetting about what's happening in the here and now and what's become a very short-term world. I hope our approach to financial markets and investing resonated with you. If it did, I invite you to visit our website at asburyresearch.com to get more information about us and our data-driven models. You can also get access to more free audio and video presentations just like this one by subscribing to the Asbury Research YouTube channel. We just produced our latest Following the Money with Asbury Research podcast on Sunday, June 4th, and it's there waiting for you. Thanks for watching. I will see you again soon.